and welcome to the Business Standard Morning Show. I'm Kanishka Gupta. Let's have a look at the stories for the day. Tesla CEO Elon Musk has been trying to drive onto Indian roads for some years now, but he has been hitting a speed bump of import duties. India, now the world's third largest vehicle market, refused to agree on Tesla's request to lower the import duty on cars, which can be as high as 100%. While the government insisted Tesla to make in India, the electric car maker wanted to test the market first with imports. With the automaker changing its approach recently, the deadlock may not last long. Tesla is now open to manufacture in India. Does this mean you could soon get behind the wheel of a Tesla? What challenges will Tesla have to overcome before that can happen? Bhasar Kumar brings you the answer.
If you've been longing to drive a Tesla on Indian roads, you must have been disappointed by the developments in recent years. In January of 2022, responding to an Indian's tweet asking him for updates on when Tesla would launch in India, Tesla CEO Elon Musk had said the EV maker was still working through a lot of challenges with the government. But the situation has improved. That's because Tesla has reportedly changed its approach. It is considering a plan to manufacture its EVs in India, moving away from its earlier demand of lowering the import duty on completely built units first. These duties stand at 100% for cars costing $40,000 or more and 60% for those costing less. At present, the most affordable Tesla, the Model 3, starts at slightly more than $40,000 in the US market. The Financial Express reported on May 18th that a team from Tesla had a meeting with key ministries and officials in the Prime Minister's office over a proposal for manufacturing in India. The report says while Tesla could still ask for some duty concessions, government officials have proposed a different approach to meet its demand. The government will offer import duty concessions on components required for domestic manufacturing, instead of allowing Tesla to import completely built units at concessional duty. This would be similar to how the production-linked incentive scheme for mobile devices works. According to a separate Reuters report, the factory Tesla is proposing to set up in India will build EVs for both domestic sales and exports. But hold on, your wait for a Tesla has only gotten a little shorter, since there are many challenges the car maker will face while entering the Indian market.
They need to get customer acceptance, they need to set up a service network, and it's electric vehicles, so charging infrastructure, a lot of other aspects are there. One, entry into any market, in India and market in particular for a new OE is challenging. Electric vehicle adds to the challenge, and if it's in a limited price range, the share of market or the amount of numbers that you can sell are limited, and therefore, if you want to get scale, you have to be a significant player in that segment, which is also challenging.
First challenge is that India is a price-sensitive market, and to have a foothold here, they have to reduce the prices. Second, setting up a huge supply chain in India, they need to qualify vendors and suppliers. Third most challenging problem is hiring local talent and upskilling them to their quality standards. And fourth major challenge is regulations. There are a lot of complaints and regulations they have to comply in India, and to understand that and comply with all of them, that's going to be a challenge and time consuming for them.
Whether or not Tesla can finally drive into India still depends on the pricing of its EVs. And whether or not Tesla models become more affordable will depend on whether it can actually build EVs in India and whether it can launch models priced less than its Model 3. The first is a function of how solid the business case is for setting up production in India, since consumers in India cannot match the purchasing power of their Chinese counterparts. China accounted for over 30% of Tesla's global sales in the first quarter of 2023.
Looking at India and manufacturing in India, it has, in the current geopolitical context, it makes sense. because looking at what the US administration and the US is offering and encouraging firms that have engagements in China to also, onshore or to look at, plus one strategy, it makes uh, quite a lot of sense for Tesla to consider India as a manufacturing base, not necessarily only for the Indian market, but also looking at the ASEAN market, and also if the EU-India FTA comes in, leveraging that FTA also for parts made in India, and of course, looking at the Indian market.
With regard to more affordable models that can capture a bigger slice of the Indian market, Tesla is expected to launch a smaller electric hatchback, which has been described as the $25,000 Tesla or the Tesla Model 2. Without considering import duties that would be applicable if it is still built outside India, such an EV could cost an estimated 20 lakh rupees under the current exchange rate. This could be a game changer in the Indian market, especially if built locally. According to one analysis, well-off Indians are mostly going for cars in the 20 to 25 lakh rupees range, with the segment clocking a compound annual growth rate of more than 80% over 2019-2022. It accounted for over 5%, or about 200,000 units of the cars sold in 2022, and almost 7% of the car sales in the first 2 months of 2023. Even if Tesla overshoots this range by 4 to 5 lakh rupees, experts say its brand value and mystique would see it through.
Looking at the Indian market specifically, the Indian companies like Tata and Mahindra in a certain segment, you have, let's say, some Korean, and you have the Chinese companies who are there. And then, like you said, the Volvo, BMW, and Mercedes, and some other small players who are in this space. So if you're looking at an offering, right, and which segment you are actually going to position your vehicle, you have to choose it very, very carefully. And therefore, this new segment that they're looking at, which is the hatchback that you have talked about, makes good sense.
Tesla could also benefit if the PLI scheme for EVs and advanced chemistry cell batteries is modified, as reports suggest it could be. But the bottom line remains pricing, which could be a challenge. The Tesla Model 3 was introduced in 2016 for a price below $35,000. But Tesla was able to deliver the EV at that price for only a short period of time. A similar situation with the future Model 2 could upset many of its plans in India.
If the latest rounds of negotiations work out, a proposed Tesla model could be your next all-electric ride. Moving on, last week, the Finance Ministry had announced the inclusion of international credit card transactions under the liberalized remittance scheme. Now, it will attract a 20% tax collected at source, or TCS, from July this year. Amendment of the Foreign Exchange Management current account transaction rules has raised concerns from several quarters that have been sending money abroad. Tariq Ahmed elaborates how the 20% TCS on foreign remittances will affect you.
The Liberalized Remittance Scheme, or LRS, of 2004 allows Indian citizens to remit up to $250,000 abroad annually without prior permission from the Reserve Bank of India. According to a May 16 notification of the government, international credit card transactions made abroad are now included in the annual limit of the LRS. However, the same is not applicable for shopping from foreign online platforms by residents while in India. That makes your international shopping expensive. But the tax collected at source, or TCS, is not a final tax. A TCS payee can claim a refund for the TCS as his tax payment against regular income and adjust it against the advanced tax payments. But RBI approval will be required for spending beyond this LRS cap.
It will definitely affect the cash flows of each and every individual who are looking to remit these money, or even if for people those who are going out for any sort of tour activities. that will be affected to everyone, but it's a cash flow issue and not a additional tax issue. However, for people, those who are taxpayers and they have their tax liability, in fact, they can take this as an opportunity to plan their advance taxes. Like, if you are any which way is going to remit money outside India, so that there is going to be this 20% of TCS, then they may pay less amount of advance tax, or the self-assessment tax, which otherwise they were any which ways required to pay. So for people, those who are liable to pay tax in India, they can they can adjust this money against their tax liability. So for them, again, it may not be a cash flow issue, but only for people who are not liable to pay tax and they are still suffering or they have to go through under the TCS, for them this will be a cash flow issue.
Remember, the card issuing bank may also charge additional forex markup (GST) on the card usage abroad. The new rule will not be applicable for the payment made out of the funds held in resident foreign currency. There are no changes in remittance for the purpose of education or medical treatments abroad. Thus, your foreign vacation is also going to be more expensive, as you have to shell out a higher tax collected at source from July 1st. The TCS on remittances for booking overseas travel packages will increase from the existing 5% to 20% if it exceeds 7 lakh rupees. The Finance Ministry has clarified that changes in the LRS norms do not cover overseas business trips of employees sponsored by their companies. The inclusion of international credit card expenses under the LRS is aimed at bringing parity with international debit card expenses, which are already under LRS. In 2021-22, $20 billion was sent abroad through LRS, with $6 billion sent between October and December alone. The Finance Ministry's notification also points at instances where LRS payments are disproportionately high compared to the disclosed income.
For all these liberalized remittance scheme, this is as per the government data, they figured out that, in spite of having earlier the maximum rate was 5%, they still found that there was a lot of taxpayers who just took it as an extra cost. Like, if you are going up overseas and you are making some payment for 10 lakhs or 15 lakh rupees, they just took it as an extra cost and they never bothered to file the corresponding Indian income tax returns. So in order to make it a little more onerous and cumbersome for the people at large, because 20% is obviously a larger sum, so this will incentivize people that that 20% is stuck now with the government, so it will make sure that they will go ahead, file their income tax return and disclose these travels and related expenses.
And that is not all. Higher TCS will increase the cost of sending money abroad for Indians, potentially leading to a decline in the amount of remittances sent. This could also discourage investments in foreign assets such as real estate, stocks, and bonds. As the fund stays locked in until the refund from ITR is received, the small and medium enterprises may also experience shortage of working capital. The introduction of 20% TCS on foreign remittances has invited a range of comments from industry players, most of whom expressed uncertainty regarding the whole situation. However, amid the concerns raised about the applicability of 20% TCS, on May 19, the Finance Ministry has excluded international debit and credit card transactions up to 7 lakh rupees from the LCR limit and will not be attracting any TCS. Experts believe 20% TCS is high, a sudden jump from the previous 5%. They also emphasize the impact of the move on SME cash flow, overseas travel, and foreign investments from India once the revised TCS is implemented.
The revision of the liberalized remittance scheme last week was aimed at prudent foreign exchange management and prevent bypassing of the LRS limits in international transactions. Meanwhile, equity markets in India witnessed downbeat sentiment last week as concerns over a looming US debt default made investors jittery. As Q4 earnings now come to a wrap, will equities shrug off the volatility and stage a turnaround in the near term? Harshita Singh finds out in this report.
Equity benchmark indices BSE Sensex and NSE Nifty ended 0.5% and 0.6% lower respectively last week, as against a 2% gain in the preceding week as Q4 earnings failed to relieve the streets of worries related to a possible US debt default. The losses were led by pharma, oil and gas, metal and auto indices, which dipped 1 to 3% on the NSE during the week. Meanwhile, realty, IT and bank indices were the only pockets that bucked the overall trend and gained up to 1%. The mid and small cap indices too maintained their outperformance over the large caps and closed the week with gains of up to around 1%. Going ahead, analysts believe markets could see a brief correction in the short term after the 6% rise from March 2023 lows. This weakness, they say, will be short-lived, which investors should use to increase their allocation.
From March end, beginning of the April till now, we have seen a good rally from around 16,800 level to 18,400 kind of level. We have seen a good one-sided rally. Now, in the extremely short term, there could be small pullback. Those pullbacks should be considered as an opportunity to accumulate good quality stocks. The interest rate cycle in the US, the FOMC has more or less run through the cycle. We don't think there is going to be much higher interest rate hikes from here. The inflation problem is more or less behind us. In India, we already have, RBI has already paused the interest rate hiking cycle. Eventually, after a small correction, we think that Indian markets are likely to move to a new all-time highs.
In the week ahead, the Q4 results of major companies like BPCL, LIC, Policybazaar, Nykaa, M&M, Hindalco, Vodafone Idea and Sun Pharma, among others, will remain in focus as the earnings season enters its last leg. Globally, the manufacturing and services PMI data from Japan, Europe, the US and Australia will be tracked. The FOMC's latest minutes, the advanced Q1 GDP estimate and any progress on the debt ceiling deal in the US will be the other crucial triggers this week. That said, technical charts also suggest an overall bullish trend for the markets in the near term.
The broader trend for the Indian benchmark indices continue to remain bullish, while for the shorter term, we see Sensex having a resistance of 63,000 and support of 61,000 level. Similarly, Nifty is facing a barrier of 18,500, whereas the support for the index falls at 18,000 levels.
That said, investors could remain fence-sitters this week. The RBI's decision relating to the Rs 2000 currency notes and the developments with respect to 20% tax collected at source on credit cards for international transactions will be on top of their minds before they decide to invest in markets.
The ongoing US debt ceiling concerns and worries about higher interest rates for a longer period and a looming recession are going to keep investors on tenterhooks this week. India and the UK, on the other hand, are back on the negotiating table to thrash out the contours of free trade agreement. But a tussle is brewing between the whiskey makers of both the nations. It is over Angel's share. What is it, and why whiskey makers are sparring over it? Tariq Ahmed has the answer.
During the period when the liquor is in the wooden cask for maturing, about 2 to 3% of the spirit evaporates in cold climate. It is called Angel's Share. It inspired British filmmaker Ken Loach to make this movie called Angel's Share in 2012. According to legends, the disappearing 2% of spirit is the share of angels and they come and drink it. When the casks are filled with the freshly prepared spirit, the sheaves of the cask absorb 2% of the spirit in around 48 hours. Then it permeates through the oak pores and the gaps near the joints. In Scotland, every year 2% of the alcohol evaporates. But when it comes to brewing, temperature makes all the difference. Liquor matures rapidly in warm weather and the cold climate slows down the process and prolongs the wait. So due to the higher temperature, Indian whiskey matures faster than Scottish whiskey. The ongoing tussle between whiskey makers of India and the UK is revolving around this maturity age. Those in the UK are demanding that in order to be classified as whiskey, the spirit should be matured for at least 3 years inside the casks. But the Confederation of Indian Alcoholic Beverages Companies has called this unfair. They say that because of higher temperature in India, the angel's share is substantial and keeping the spirit in cask for a longer period is unaffordable. The angel's share is determined by some other factors too, like the quality of malt, the wood that the cask is made of, humidity, exposure to light, etc. According to the Director General of Confederation of Indian Alcoholic Beverages Companies, Angel's share in the Indian condition is 10 to 12%. That means in 3 years, 1/3 of the spirit will disappear. That's the reason why Indian whiskey makers are against the UK's demand to make the maturation period 3 years to be classified as whiskey.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
That is all we have for you today. For more news, views and insights, follow and subscribe to Business Standard. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.